My next guest expects the Fed to hold rates steady at Wednesday's meeting, but says an upward surprise on that CPI number tomorrow could prompt a hike. He also says we're currently in a cardboard box recession. Here to explain is Jeff Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeff, it's great to see you. We've often used the cardboard box as an economic indicator, but you seem to be going a step further here.
Well, last week's news makes it official. Europe entered a recession in Q4 and Q1, but it was the mildest ever. And that might not be too surprising, but it's also too much of a generalization because not everything is in a recession right now. It's what I'm calling a cardboard box recession. During the typical global recession, you get all areas of the economy turning down: manufacturing, trade, services, retail, construction. And they do so around the same time. But now, only manufacturing and trade seem to be in a global recession, not just in Europe, but on a global basis. So I'm referring to this as a cardboard box recession because manufactured items and anything that we ship tends to go in a box. And demand for corrugated fiber board, which is what most cardboard boxes are made from, has fallen to a similar extent we've seen in past recessions. But Kelly, that contrasts with services industries, which have continued to grow. Dom talked about it, I think, about 10 minutes ago with regard to the cruise ships. Now we're seeing the Airline Industries International Air Transport Association double its profit estimates for this year in the surge in flying. So all this explains the mild economic and earnings downturn so far. It's just a cardboard box recession.
You know, you're absolutely right in terms of the pandemic kind of reset that we're going through. But I'm just going to go out there and be extra bearish for you. What if that's going to happen and then the broader recession hits? In other words, I look at the news this morning where Grubhub is now laying off 15% of its workforce. And, you know, yes, travel services are the strongest part of the economy right now, but the business cycle hasn't really turned yet. When that happens, we'll have had a previous recession, a cardboard box recession, and then the real thing. It's just going to be this long, drawn out. And then we had the real terms recession last year because of inflation. So people are going to feel like we've been in a recession for 5 years at that point.
Yeah, and I'm afraid you're right. I think the second half of the year is going to keep us on pins and needles over the fact that the manufacturing, the cardboard box recession, could spread into services. One of the things I'm noticing is that last year we had that change from shortages to gluts in the global market for goods, cardboard box stuff. That took place in the middle of last year. Now I'm seeing it in the labor market. You just mentioned some of the layoffs. But generally, if we look across the globe, the MSCI World Index of Companies, I'm counting the number of times I'm hearing job cuts, reduction in force, layoffs, headcount reduction, furloughs, downsizing, compared to mentions of things like labor shortages or inability to hire or difficulty in hiring. And we've gone from a labor shortage environment over much of the last 18 months to now a labor glut environment. And if you combine that with, I'm seeing way more mentions of layoffs than difficulty in hiring. And that might be an indicator that as we look to the second half, could get tough in the service sector.
Absolutely. I don't mean to interrupt, Jeff, but I actually think this is really important. I want to make sure that people hear, and I want to give you headline credit. You know, when you say that we're in a labor glut, most people would say, no, that can't happen until the unemployment rate is much higher than it is now. But you think that shift has happened?
That's what we're hearing from business leaders. Now, it might take a few months for that to show up in the actual data, right? Usually they tell shareholders and make announcements about coming layoffs before they actually implement them, right? Usually it's 3 to 6 months later. So I'm thinking that's the story for the second half. And Kelly, also, lending conditions also contribute to the weaker jobs outlook. There's a clear and intuitive leading relationship between banks' lending standards and job growth that usually leads by a couple of months. And of course, we all know what happened in March.
We have to talk about international stocks before you go, because despite everything we've said about what's happening in Germany and all the rest of it, you've been a big fan of international, and you're sort of doubling down on that for the back half of the year.
Yeah, I am. You know, if you look outside the U.S., the rally is much broader. The bull market is much broader than in the U.S. If we look at an equal weighted index, which represents the performance of the average stock since the end of October when stocks bottomed, the equal weighted international EFI index is up well over 20% in a bull market. But the equal weighted S&P only up 4% since then, showing how narrow that U.S. advance is. I think the greater number of stocks helping to push the overall market higher internationally is a better base of support as we look to the second half of the year.
Yeah, and the Japan story, I mean, it's just fun to see it go from, you know, all of us writing, oh, Japan, and it's never going to get its act together. And now it's like, Buffett loves it. The stock market's doing great. I know you share that enthusiasm.
Yeah, that's right. So the Tokyo Stock Exchange has changed some of the rules. Companies are really looking to boost their price-to-book ratio. They used to hold a ton of cash. They're starting to employ that into share buybacks, a lot of things to really turn around profitability there. And investors are noticing, yeah, the Nikkei has doubled the return of the S&P 500 this year.
All right, Jeff Kleintop, we appreciate it. Thank you so much.